Today's date is significant, and the reason is as follows. Just yesterday, the IMF stood up in Davos, Switzerland, and announced that the global economy is facing the worst economic headwinds since World War II. What does this mean for us and our future? It could be bad news, but depending on how you look at it, it could also be very good news. Want to know why? Stay tuned. This is one of the most complex macroeconomic environments I've ever experienced, and I think most people are probably interpreting it wrong at the moment. I'll take you through a history lesson and then dive into the current situation. Are you ready to find out why I'm concerned? Why World War II? World War II was a fascinating time because the entire world was either stuck at home or fighting on battlefields. When everyone returned, there was no supply of resources or goods anymore. Global supply chains were disrupted, and everyone started consuming again. What happened then? Stay tuned to find out. Inflation skyrocketed to about 133% or even higher. This period was fascinating because interest rates rose, and the first thing that happened was the economy went straight back into a recession. Inflation turned negative because of a massive tightening of monetary conditions. What did this mean for people back then, and what parallels exist today? Prices for goods increased without wages rising accordingly. People couldn't get the goods they wanted, just like now, and everything collapsed. We went back into recession and eventually saw better times. But what can we learn from the 1940s and 1950s? The answer may surprise you. The next similar period was 1974. Many say it feels like the 70s again. Inflation. But the inflation period of the late 70s was driven by demographic changes. The baby boomers all entered the workforce at the same time. It was the largest demand shock the world had ever seen. But what's different this time? We experienced a supply shock caused by the oil crisis of the Arab oil embargo. That isn't repeating now. What's actually more similar is 1974. Back then, oil prices tripled, interest rates rose, inflation soared, and the immediate consequence was the economy collapsed. Does that sound familiar? The stock market fell by 50%, and the ISM index, a good indicator of the business cycle, hit a historic low of 30 in just 4 months. We're now seeing the exact same kind of development. What does this mean for the future of the economy? Stay tuned to find out. You might wonder, are the 70s back again? Yes, and inflation dropped after 1974. People thought inflation would continue forever, but it didn't, neither in the 1940s nor the 1970s. What can we learn from this, and how can we apply it to today? The next example was 1984. We saw massive trade disputes, the dollar was strong, interest rates rose, and inflation was high. Everyone feared a repeat of the late 70s and early 80s. How did the economy respond to this? The answer may surprise you. Paul Volcker raised interest rates too much, and the economy collapsed. It didn't lead to a recession because the Fed quickly lowered interest rates, but the dollar continued to rise, causing more problems. We had to stop the dollar to avoid destroying the global economy. Could history repeat itself? The next time we saw something similar was 2008. Remember? Oil prices were at $147, inflation at 6%. The Fed had lowered interest rates because the economy imploded. The same thing happened in 2018. High oil prices, high inflation, and the Fed raised interest rates. What happened then? The economy quickly tipped over again. Why does this phenomenon keep happening? Many extrapolate inflation endlessly, but that assumption actually collapses because we tighten monetary conditions. What does this mean for you and me? For us, tightening monetary conditions means that the cost of our mortgages has risen faster than ever before. Money we borrowed suddenly became much more expensive. Our wages aren't keeping up with rising living costs. What does this mean for our daily lives? We feel poorer, consume less, and cut back on certain expenses. People overstretch themselves with home purchases, and interest rates keep rising. Rising oil prices drive up the cost of gas and other goods, and the strong dollar makes the situation worse. Where does this lead? All these factors suggest the ISM index could fall back to 30, like in 1974, a frightening drop. If we're not careful, we could experience a severe recession. possibly with -5% GDP growth. How bad could it really get? The next minute brings more clarity. The recession could be short, depending on what the Fed does. We have the same setup as in the past. Leading indicators signal pain, monetary tightening is underway. Tech companies are laying off employees, profits are shrinking because they can't raise prices enough. What does this mean for the economy? Amazon, one of the largest employers in the US, says they hired too many people. That's not a good sign. The answer to higher prices is higher prices, and that's what happened. But what will break next? A bank, a hedge fund. The real answer is the economy itself. The Fed will have to pivot. The imposed monetary conditions are the strongest tightening in history. China is slowing down due to lockdowns and recession. Europe is grappling with war and energy transition. Global growth is lacking. How bad will it really get? Let's look at scenarios. Technically, a recession means 2 consecutive quarters of negative growth. For us, it means job loss and wealth loss. Could we slide into a depression? The answer is complex. Stay tuned. A depression is unlikely, but not impossible. A key factor is the Fed's balance sheet. When they print money, the purchasing power of the dollar falls. Many think this leads to inflation, but it leads to something more insidious: currency devaluation. What does this mean for our assets? Scarce goods like stocks, real estate, gold, and crypto increase in value, but only reflect the currency's devaluation. It looks better on paper, but is it really? It's a trick, and it could be played again soon. How will this affect us? This time, direct cash transfers to individuals could happen. Some countries are already doing this. Regardless of political opinions, we must recognize that this will happen. Empty office spaces show this isn't a normal recession. What does this mean for jobs and real estate? If companies like Apple say they won't return to the office buildings remain empty. Residential real estate depends on jobs. If jobs are lost, what happens to the housing market? The answer may surprise you. The IMF warns of major economic challenges. Currency devaluation is real. In 1964, coins switched from silver to copper. That shows the devaluation of money. We're now paying the price for it. What can we learn from history? Macroeconomics is history. When the Chinese printed paper money, their empire collapsed. The same happened with the Roman Empire. Are we witnessing the end of the American Empire? The next minute reveals more. I think it could happen with alarming speed. In 1974, it took just 4 months to go from everything's okay to the worst recession since World War II. Due to rapid monetary tightening and rising prices, what does this mean for the coming months? We could face very difficult months ahead, economically and for the markets. The question is, what's next? If the Fed pivots, they could stop reducing the balance sheet and start lowering rates. But with rates near zero, only money printing remains. What does this mean for us? Credit markets are drying up, an indicator. The housing market is tipping over. Money printing further devalues the currency. When there's too much of something, it loses value. What happens to assets and our purchasing power? Scarcity increases value. When there's too much money, it becomes less valuable. Stock buybacks reduce the number of shares, boosting value. Real estate, gold, and crypto are scarce goods. But how long can this magic trick work? When markets rise, people feel richer, spending increases, companies lay off fewer employees. But this is just optical. The saying, "The bull climbs the stairs, the bear jumps out the window," fits here. When will the rally end? We could see a scenario like 2000, a typical recession with a longer recovery phase, or like 2008, where the Fed's intervention had a quick impact. The Fed has intervened multiple times in the past. What will it do this time? In 2018, the Fed pivoted after Trump applied pressure. The economy can't handle higher rates because many are in debt and the population is aging. We face similar problems. What does this mean for our future? Companies aren't returning to offices, REITs own empty buildings. The Fed carries massive debt and continues to lower rates. Can this go on? The next minute offers insights. With supply chain problems and stagnant wages, household net worth will shrink. Everything is leveraged. Loans on real estate, stocks. If collateral loses value, the system risks collapsing. Is this inevitable? Governments try to reduce debt through financial repression by keeping inflation higher than interest rates. This reduces the real value of debt. Good for debtors, bad for creditors. What options remain? Fiscal stimulus or direct support for the most vulnerable. But high debt levels make action difficult. The system can no longer be cleaned up as before. The world is too indebted. What can we do? In the 1940s, the economy recovered after a collapse. Negative real interest rates spurred investment. A massive boom followed. Could history repeat itself? Companies might invest in domestic factories again, and technology drives growth. Governments could stimulate. Stability and a boom might follow. Is this a realistic scenario? Although it feels like the end of the world, positive developments could follow. After major crises, great progress often followed. Could this be the case again? The fourth turning could mean a reset. New institutions, new agreements. But we must be ready to embrace change. Are you ready for the shift? The bond market often reveals the truth. If we act correctly now, opportunities could arise. If you want to build wealth, now is the time to act. Are you ready to take the next step? History shows the rise and fall of empires. We may be witnessing such a shift. Old ideas no longer work. Adaptation is necessary. What does this mean for you personally? Bull markets make us think we're smart when we make gains. Bear markets show us reality. Many will realize they've built on false assumptions. Are you prepared? When the crash comes, it happens quickly. The most important message is to stay vigilant and not complacent. The IMF isn't warning without reason, but with knowledge, we can seize opportunities. Where do I get my money? From banks in Japan. The Japanese save. I use debt. Different financial strategies have different effects. What can we learn from this? When Nixon took the dollar off the gold standard, money became fake. But the economy boomed because money was printed. What happens when governments print a lot of money? It leads to inflation. As stated in Rich Dad, Poor Dad, I don't work for money, I work for gold and silver. I don't save dollars, I use debt for real estate and pay no taxes legally. Gold and silver are my hedge. What's your strategy? Thank you for watching this far. If you enjoyed this video, subscribe to my channel and hit the bell to never miss future content. Share your thoughts in the comments. Stay tuned for more insights into the economy and finance. See you next time.